Hello and welcome to CMB Connect. I'm your host, Val Buresh, and with me in the studio is Ryan Black. Ryan went from congressional staffer on Capitol Hill to becoming a partner at Black, Mann and Graham, a Texas firm that's been quietly keeping hundreds of lenders out of hot water since 2000 with bulletproof mortgage documentation and document preparation and compliance support. Ryan, welcome. It's great to have you on CMB Connect.
Well, it's an honor to be here. Thank you, Val, for having me.
And before we get into the GSE topic that I really want to get into and discuss with you today, I want you to give everybody the quick version. How did you end up at BMG from a congressional staffer?
Well, it's a long story, but it started with my father was actually in mortgage, and he worked for some wholesale lenders despite having a legal background for decades until he and Calvin Mann and Gregory Graham started the firm Black, Mann and Graham back in 2000. Growing up, I didn't really know what I wanted to do. I just didn't want to do mortgage because I was around it so much. And the one thing that I kind of connected with was politics. So right after law school, I got a job on Capitol Hill. And of course, one of the first topics that comes across my desk is a mortgage related topic. And here we are. I got sucked right back into it, even though I tried to run away. Here we are.
And here we are in the CMB Society. How did the CMB designation get on your radar?
I guess it's a similar story. I remember my dad being really involved with MBA throughout his career. And one of the earliest memories was when he was teaching one of the School of Mortgage Banking classes out in Alabama when I was probably 10 years old. And I went out to that and got to hear him do his spiel on what Fannie and Freddie are all about. And so I was one of the few 10-year-olds that even heard of Fannie and Freddie, I suppose, at that age. But the CMB really got ramped up for me, even though I knew about it for forever. Right after I did Future Leaders program with MBA, that was really a career-defining program for me to go through. I learned so much, developed so many fantastic relationships. It was a great experience. A number of my classmates went right in to take the CMB exam or study for the CMB exam right after Future Leaders. I was wisely counseled into finishing CMB first, 2 and 3. Once I wrapped that up, I started on my CMB journey with my sponsor, Alan Fowler. And I guess we're just now in early November, about a year away from when that really started and intensified the study.
Love this connection with the family, both from how you started in mortgage and also the impact of your father on your orientation and decision to search for more, to get more designations and involvement with the MBA.
Yeah. It's always been instilled, not just through him, but through the mentors like Calvin Mann that I've had in my professional life to give back to the industry. And when you do that, you'll grow so much. And I see the CMB Society align with that perfectly. You see the passion. I mean, geez, the first session I go to, the outgoing president shows everybody his CMB tattoo. That was indicative of the passion of this group. And I love it. And so I'm eager to get more immersed in the society and help and try and give back to an industry that's given me so much.
That's wonderful. Well, let's immerse ourselves today into the headline stuff that we heard recently, both on X, but also in the newspapers. And let's start with the conservatorship. Are we actually living this time? The FHFA Director Putti keeps talking about a partial IPO, 5% by the year end. And I wanted to get your gut check, Ryan. What's your read on whether this partial IPO would actually happen this year? And are Fannie and Freddie getting out of conservatorship Is there any chance for them of getting out of conservatorship in 2026?
I think it would be difficult, again, it being early November, to reach that goal of doing this by the end of 2025, especially with the changes we've seen at Fannie Mae recently. It's interesting. I just got back from the Texas Housing Summit that the Texas MBA put on. It was a wonderful symposium that they organized at the LBJ Library at the University of Texas. And a number of the speakers there hit on this topic exactly. And the one thing I noticed that is a bit confusing, I think, to most, especially those inside the Beltway in DC, is that I think traditionally this was the fate of Fannie and Freddie rested in the Department of Treasury, the Treasury Secretary. And since Pulte has been appointed at FHFA, we've seen a stronger opinion from that role as to how it should happen, when it should happen, that kind of thing. And so that's been a dynamic that I don't know was really anticipated. Treasury and FHFA seemingly not being on the same page. I think the way this administration's run in the past and certainly this year, they have a bit of that internal struggle, and then eventually some kind of proposal comes out of that. I'm not sure what that'll look like. Certainly, there's a role that I think Treasury needs to play, given how most of conservatorships govern through the PSPAs. But whether or when they will come out of conservatorship is way beyond my understanding of all of this kind of stuff. I'm not even sure what Treasury's timeline would be on all of this. As you mentioned earlier, I was a congressional staffer. I worked on the Senate side, and during that time that I was there, the big GSE reform proposal came out of the Senate Banking Committee, Chairman Johnson and Ranking Member Crapo at the time. And it was a bipartisan solution. NBA had their fingerprints all over it. It was an interesting and I think realistic take on how to get Fannie and Freddie out of conservatorship. Unfortunately, it obviously didn't pan out. But what I think is important that isn't being discussed is the role I think Congress needs to play in all of this. Of course, everybody left and right, I would say, or the vast majority of people agree that conservatorship needs to end at some point. The sooner the better. Otherwise, Fannie and Freddie will continue to lose their characteristics that make them nimble, make them the private entities that they once were. But I suspect that the best thing that can be done for investors, global investors of MBS, is to have Congress say, okay, this is how we're going to treat the GSEs from now on. We'll provide an explicit backstop. And until we get to that point, I'm not sure that we'll have that certainty that we need to release Fannie and Freddie and not totally disrupt markets, right? That's no matter what administration's in place. I think politically it's not feasible to do unless you can ensure that somewhat smooth transition. And until that time, I think that the best way for this to happen is through Congress. But seeing as that how they can't even agree to keep the doors open, I don't see how they're going to get that done.
Right. I have not thought about the role of Congress in this conversation, actually. So you opened my eyes to something that is really important. When I think of conservatorship, I normally think of FHFA and the actual administration putting pressure on those conversations, the NBA lobbying, but I've never thought about the role of Congress. And that's something that I will take away from this conversation afterwards and think more about that.
Well, yeah, unfortunately, they've given you reason not to think about them because they've been very quiet. And my hope is that one day they'll kind of wake up and start legislating again. And they can really bring a lot of certainty to all of this, not just in the explicit backing, but affordable housing mission. What goals should we be setting? How do we monitor them? How do we hit them? There's just so much to this very complex deal. The last real issue that hasn't been resolved since the great financial crisis, you would think Congress would want to play a role in that. But again, it's been too long. And so I understand why any administration would want to try and wind this down. I don't think that doing so without Congress will upend the apple cart, but if you don't do it right, it certainly could.
Yeah. More to come. I would love to continue this conversation with you because this is fascinating. But let's move on in the interest of time to the hot button proposals that we have seen being suggested, so to speak. Let's start with assumable mortgages or portable mortgages. What I have been wondering, if every Fannie and Freddie loan became assumable tomorrow, let's say, would that move the needle of the transaction volume that we are seeing in the market, or would it just create a servicing nightmare somewhere down the road? What do you think?
I think this is a little bit outside of my level of experience or expertise, but I do think there would be a number of issues, especially if you're doing it to loans that have already closed. If it were on a go forward basis,
right,
then that would create a new product that could potentially open things up. But all these proposals to address affordability, while they I think come from a good spot, are a bit frustrating to me, because we know what the issues are when it comes to affordability and getting people, first-time home buyers, into homes. And that's address inventory, right? And we got to continue to build. I'm out here in Texas. We do a pretty good job of it. Every state has its issues with local zoning ordinances or regulations that slow construction. But we're seeing how, at least in Texas, how when you regulate it correctly and incentivize new builds, lenders will do that, especially here in Houston. There's actually, again, at the Texas MBA Symposium, they talked about how Houston has been a model for lack of zoning regulation, ultimately promotes new builds. And so I think that, not to get too far away from the assumable topic, but I think that the frustrating part is we know what issues are causing this affordability crisis in the housing market. And we know how to address them, and we just can't, because it's difficult. It's a fractured system. Each state and each municipality kind of has their own rules of the road. So number one, I think that would be the best way to address it, is for everybody to get on the same page and encourage new construction in a safe manner. I don't think that credit availability is a major barrier to first-time home buyers. I think it's just this. Well, it's mostly this inventory issue.
Yeah.
And so if we're able to get, folks in these starter homes out of the starter homes and into their next home, I understand why going after proposing something like an assumable mortgage to try and get them to come out makes sense. I'm more in line with, hear Bob Brokesmith talk about, raising the capital gains tax on treatment on the sale of a home. I think that might clear up some more inventory than in a safer manner than creating these assumable products and causing everybody to your point, run around in the servicing department.
Yes.
Not too happy about that.
Yeah, and we only have to look at the FHA and VA record. The uptake hasn't been as big as we were hoping with the assumable mortgages.
I agree. I appreciate the solutions that people throw out there, but I think that we know what the issues are, and our energy should be more focused on those.
Let's go over those proposals, because it's interesting to at least comment on them and consider them. The next one that I wanted to bring to our discussion is the 50-year fixed mortgage. 50 years, half a century mortgage. This is something that the Trump administration is pushing hard for. just from our perspectives as CMBs, would a 50-year fixed mortgage open up new borrower pool that is good business, or are we going to create a situation where we are creating the factors that can bring default risk down the road?
Yeah, my mind goes right to default risk. It also goes to, what's the benefit to the consumer on a 50-year product, and how much are you paying on interest over the life of that loan? Again, I'm so far removed from the Wall Street aspect of all of this, but who wants to purchase that? I mean, I guess if they get interest that's twice the amount of the principal, that might be worthwhile. But how do you price that? How long does somebody stay in a 50-year mortgage? I don't know.
What's the prepayment risk on those? We don't know. Yeah.
Who knows? Who's going to be in that for 50 years? Yeah, I question, how much time and energy the administration will really put into putting that type of product out there. As long as it's being discussed, I think we're seeing it all over LinkedIn and social media. I don't think that industry is going to embrace it, and so that'll likely be an item that goes back to the drawing board, I suppose.
Right. Yeah. Well, next one. Fannie Mae is dropping the minimum credit score. There is no more 620 floor in the EU starting November 16th. Do you think this is a growth opportunity for mortgage lenders, or, let's say, portfolio grenade?
I think it's growth opportunity. I think we talk a lot about how Fannie and Freddie have taken away from the government portfolio all the quality loans, right? And so I think that if there's room within Fannie and Freddie to take a little bit more risk on borrowers in that space. Now, how much risk is always the question, right?
Yes.
And,
yes.
That'll.
And also, what I also think is that the story doesn't end with the credit score. There is equity in the home, the LTV, the CLTV, the ability to repay that loan.
Yeah, that's a good point. Is we when we take into consideration all of the rules and regulations that lenders have to implement in order to just originate this loan, I don't think that we're going back to 2006, 2007 with lowering credit scores. We have safe products. We're a very different market than we were back then, and I'd argue that portfolios are a lot more safe and sound compared to where they were back at that point in time. That doesn't mean we should go run amok, but I don't think anybody's proposing that either.
Right. Oh, from my perspective, when I look at the numbers, I look at the data that describes the loans in the Fannie and Freddie pools. But what we don't see from our perspective as data scientists is the documentation. This is something that you specialize in. And so even if a loan has a lower credit score, but it has better risk metrics like the LTV, for example, and solid documentation mitigates that. We always talk about credit scores, but maybe it's not that important.
And we've seen it in the non-QM space a little bit as well. There's good quality borrowers out there that might not fit that type box that we have as lenders to originate loans for these people. And I suppose that this will help loosen that up a little bit. And I don't foresee it being abused because of all the rules and regulations around originating loans right now.
Well, last of the proposals, the Vantage score. We know it's fully live now, and some I've read people say the adoption of Vantage score is through the roof. And so I'm wondering if this situation with Vantage score adopted, allowing lenders to say yes to more loans without getting burned, or is it too early to tell since we're just seeing all these things happening real time right now?
Yeah, that's interesting. I mean, I've heard anecdotally good things so far, which leads me to think that we'll be fine. And again, I think that the idea of relying on one score is not necessarily a safety and soundness issue. We're not the only industry. We were the only industry relying on the tri-merge, right? And I think that I think that the ability to rely on one, the data is there, the variance isn't that significant as I understand it, and so I suppose on the safety and soundness front we'll be fine. And as long as we're again able to reach borrowers that we might not have already reached, or address the affordability issue by lowering the cost of closing, of originating these loans for borrowers, that's all a plus. That's all a good thing, and that's what I'm hearing out in the marketplace today.
Very well said. So I am wondering, based on, on our discussion today, if you are walking in a room next week full of CMBs, what are you going to tell them? What is the single move that they should make right now to stay ahead of whatever happens with the GSEs, no matter where they are, whether they are loan originators, servicers, vendors, fintechs?
The because of my background, really, I was introduced to MBA staff working in DC. My head goes right to advocacy. And so I encourage everybody, whether you're a CMB or not, to get involved. I know CMB Society has a very strong showing at things like the MBA National Advocacy Conference. There's also MA, Mortgage Action Alliance, which is free to join. It alerts you to issues that are popping up, and when we as an industry need to reach out to our elected officials to say, hey, we want you to support this bill that you're going to be voting on next week, it queues that email up for you and sends it out for you once you approve it. It makes it so simple to be a member of MA. And that's where you learn about all of this stuff by getting involved in the advocacy. And you stay at the front of the issue when you hear people like Bob or Bill Kilmer or Pete Mills talking about what they're hearing in DC. And really, to me, that's one of the greatest values that of MBA is the insight that they have, the involvement that they have. And I know that staffers on Capitol Hill and in the administration, they go to MBA to get MBA's pulse on the topic.
Yeah.
So that's always been front of mind. I'd be remiss to say I'm also the vice chair of the MORPAC committee. So please consider a MORPAC contribution as well. But MA is a free and easy to use resource. And then National Advocacy Conference, which is in April, I believe, 7th or 8th. Of 2026. That's a phenomenal conference. It's relatively cheap compared to other conferences in terms of its registration, but you learn so much at these things, and they get the elected officials and admin officials to come to us, talk to us about what they're hearing and what they're seeing. And then we get to go to Capitol Hill and talk to our elected officials and their staff about these topics. It's my favorite 2 days of the year, and encourage all CMBs to do it, whether they've attended before or not.
Yeah, it's a fantastic conference, and I've been a couple of times to the Hill by participating. I live in DC, I work in DC, so for me, I'm always attached to Maryland or to Virginia, but nevertheless, it's quite an experience. So
it is. I mean, it's an important thing to do, number one, and you get to experience the history and tradition of some of our most important institutions. And so I think it's a great experience. And again, I encourage everybody to attend at least once, if not annually.
Thanks, Ryan, for this advice and for keeping it real with us today. I really enjoyed the conversation.
Well, thank you for having me. Thank you for the warm welcome into the CMB Society. I'm eager to be a part of it.
We are better because of you and people like you who are joining the CMB Society. That's what makes the society so vibrant, the new members.
Absolutely. And I think I went the whole session without thanking my sponsor, Alan Fowler. So let me do that too before I get in trouble. But Alan was super helpful throughout the whole process. And I'm grateful for his many insights. He taught me pretty much everything we talked about today.
Fantastic, fantastic. And I know Alan very well, and I totally agree with you. He's a phenomenal individual and professional. Thanks again, Ryan. And that's it for this episode of CMB Connect. And if you're not already in the CMB Society, fix that. And we'll put links in the show notes below. Drop us a review, tell a friend, and we'll see you next time.